Yesterday, I opened a 1 DTE broken wing butterfly spread on the SPX. I was expecting the markets to go up into today, or at least I had thoughts that it would go up. I didn't have massive conviction in the markets going up. It was just a very quick idea that came across my mind as I liked the way the markets was showing that there were some potential supports at this level. And as the market retraced back to this level, I saw the same buyers in my mind being aggressive and driving price higher. So I figured, why not open a 1 DTE trade for today, targeting this level right here on the SPY. Now, I use the SPY to analyze price action as well as the SPX, but the SPX options are my preferred way to actually exercise these trades. So I analyze price action on the SPY, I use SPX options to actually execute my orders, and I use the SPX and the SPY's gamma exposure when I'm doing my analysis. These levels that you see right here are from the gamma exposure levels that I analyze at the start of the week. I've been doing that for a couple years, every single week, and I share it. I'll leave a link in the description of this video, which will show you guys what I'm actually doing when I'm plotting these levels out. Now, I consider a small trading account with anything from 2K to 5K in the accounts. I consider this small. 10 to 25K is mid-sized account for me, and then anything above, we'll say 30,000 is what I would consider a nice size account, all the way up until about 100K. Anything over 100K I consider a large account. So this is, for this video, this is generally the area or the range in which I'm talking about. However, any account size this type of information is applicable to. Now, why would I want to trade a broken wing spread as a broken wing butterfly as opposed to just buying a call if I think the market is going to go up? The first reason being is the risk control, I think, is better with something like a broken wing butterfly. As you can see, I was wrong and the market is down right now. So the position in which I'm in currently is down about $100. The max loss I can take on the trade is $370. So I'm only down 34%. That is within risk parameters when I first entered the trade. If you have a small account, then you definitely need to have good risk management as you don't have a lot of wiggle room. On top of that, if you like trading SPX options, then they can be very pricey. What usually happens is traders will trade deep out the money options because they are quote unquote cheap. But the problem with that is you're reducing your probability oftentimes for success because deep out the money options, as we know, are unlikely to work out in our favor. As I opened the trade, I was aware of the resistance up at 685. So this is that 685 resistance. This is a lot of rejection at a key strike on the SPY right here, and price could not hold above this level. This was a sign to me that the markets wants to go lower. However, earlier in the day, we can see that there was some demand growing at this level here. So we have demand here and we have potential supply building up at this level here. So as the markets retrace back down to this level and I saw this happening here, I figured I'll take the risk on being long with the expectation that the next time the market gets above 685, it's going to break out and likely go to this area. That's what I was thinking. However, my stop loss on a usual trade like this, let's just say it was a larger size, I'm actually only in one lot, so I don't have a lot of risk out at all. This right here is exactly my max risk. I have not scaled up in this trade. Today is an FOMC announcement at 2 p.m. Eastern time, which is in roughly 3 hours. And normally I might have something like 3 lots running, but I don't even have 3 lots running. So it is a very, very low risk type of trade for myself right now. But as I was thinking about this yesterday, to me, it doesn't matter if I'm in 1 lot, 2 lot, 10 lots, 20 lots. I'm thinking of things in terms of the same way as a risk manager. If I'm going to give this trade wiggle room, meaning I want to swing the trade, I need to account for what happens if I'm wrong and the market does go pretty low. In other words, a normal day, if I'm looking to get long here, my stop loss might be right in this area. So I'm probably only looking to risk maybe 20, 30 cents of the spread. But because I want to swing the trade, I want to give it a little bit more wiggle room in case the markets ends up going down, what is the threshold or how much room are you willing to give the trade? If you are swinging a position, you definitely need to be willing to give the trade a lot of room to breathe because you don't know what's going to happen overnight. And for the most part, there isn't much you can do in the extended hours unless you have a specific type of broker or maybe you trade futures. But for most traders, if you are entering a swing position, you are planning to wait until the next day to do something about it. On top of that, a margin account is required for trading spreads. And if you have only $2,000 to $5,000 in your margin account, that means you are below PDT. And that means technically you're not a day trader. So you are opening positions almost 100% of the time with the intention to swing it. If you have a cash account, obviously you can open and close your position all day long, but then that means you can't trade spreads. This video is about risk management with spreads, specifically a broken wing butterfly. I like the broken wing butterfly because you can still get asymmetrical returns. You can still get a really large profit using a little bit of capital, which is something that we all like when we are just option buyers. This right here is the body of the butterfly. So it is the 685 strike. Now, why did I choose that strike? It's pretty simple for me whenever I'm trying to make my strike selections for these types of trades. If the SPY is here and I'm thinking it might go up and it's going to go to about here, this is about a 0.30% bounce in the SPY. So as I'm looking at the SPX, I'm just going to do the same thing. If I'm buying around here, just loosely draw this up, and then we get about 0.30% is this area, and then I'm just rounding it to the nearest $5 on the SPX, and that's how I got my strike. So that becomes my target. If the SPY goes here, the SPX should be around here. Then I'm going to structure my butterfly with a price or a cost that I think is decent enough. And also, if the market was to go where I'm thinking it's going to go, there's a room for decent profit. So 685, in other words, would be right around here. Now, obviously, at expiration, there's room to make a really large return. But as I'm swing trading a position like this, that's where it's to be determined if or how long I'm going to hold the trade. It depends on what price action looks like, because if the market's gapped up above 6,875 and it was in this area here, my conviction or my belief that it's definitely going to be above this level will be much higher compared to today's open, where the market actually opened down and it's pretty much struggling down here. I don't have much expectations, or I don't have high hopes thinking the market is actually going to go all the way up here today. However, there is an FOMC announcement. So again, anything can pretty much happen on a day like today. If the Feds come out and make any type of extremely dovish announcement or so, then the market can very easily be up 1%, and 1% would put us all the way back up to here. And that is the bonus of this broken wing butterfly. There is no risk to the upside. So if the market overshoots the price or the area in which I'm thinking, which is really in this zone here, if it were to go all the way up here, at least I don't have any risk to the upside. And that is obviously a perk whenever you just buy a long call option. So let's just say yesterday I was just in the call of the 865 strike. So that's this right here, 865. So right here, I think the market's going to go up, and I just buy this call because I'm buying the high of day strike, thinking, tomorrow we're going to be above today's high. Let's just say that's the logic here. The issue with that is the price of that option at the time in which I took my entry would have been almost $1,800, which is expensive, again, especially with a small account. On top of that, by the time the market was pretty much closed, this position was down roughly 38%, or down almost $700. That is a very, very brutal blow to a small account, especially if you're considering a swing trade. Now, one can argue I could have waited until the end of the day to open the position, but again, I didn't think the market was going to go all the way right down here over the next couple hours after I opened my position. The G flip was here, so I am expecting the markets to be choppy around this strike. And this isn't the only position I have running. I do have a couple other swing trades on, such as this combo spread here actually for Friday. I call this a merge diagonal fly because it is just a diagonal merge with a broken wing butterfly. I call them merge because they merge and the P&L lines overlap, so there is no dip between. There's no valley here that turns into the red. As these spreads combined, they merge together and they create a favorable risk profile. So this is actually my main position for this week here, and this is just me looking to add some extra P&L in case the market was up overnight. Now, with that being said, this being my main conviction that the market is going to be choppy in this area here, that is the main trade that I'm looking to make some profit off of. This is extra P&L looking to add, but this video is not about this other trade. I'm trying to keep it simple by we're thinking about one position, one trade that is not working out, but I'm comfortably remaining in this trade because it is still within my risk parameters. I would be willing to stop out of this trade if it was down about $2. So $200 is what I'm giving the trade, which is a lot of wiggle room for a position like this. But the context matters here. It's a 1 DTE, so there's risk inherently involved. Anything can happen overnight. It's also an FOMC. The market has been consolidating. It's been very choppy for over a week now. So one can argue it's due for an outsized move up or down. Anything can, pretty much happen after the market has compressed like this. It can do a 3% move in a day if it wants to. And that type of stuff does happen after massive compression. I personally don't think we're going to see any type of major big move, but that's not what I'm speculating on yet. As soon as I'm done recording this video, I might take a look at some of the data, look at the gamma exposure profile, and I might change my mind, and I might run some sort of straddle or strangle for next week or something like that. But for the most part, honestly, I think traders are just exhausted from this year. I know I am, so my own bias and my own personal feelings of exhaustion is projected onto the market. And so far, I've been right for the past couple weeks. We haven't really been seeing much after this last major, explosion up here. We've just been pretty choppy. And with these types of trades, it means at the end of the year, I can still take some sort of, outsized asymmetrical type of expectation moves, but not have to risk that much capital to end the year. It's a little bit of trading defensive for someone like me that is used to trading with 10, 20, $25,000, $30,000 type position sizes. This is very small for me, but even if I had just a extremely small portfolio, this is the way I would be trading, because even with a portfolio size, I think of a good sweet spot is between 5 to 10K, by the way. If you're now starting out with a margin account and looking to get your feet wet with spreads, you can trade these types of positions here and really learn just one lot of each of these. In this case here, you need 2 lots of the diagonal just to balance out the profile, but this is a more complex spread. But you can trade this with a $5,000 account and give it, $300 in risk or so, because this is a 11 DTE. I actually opened this last week and I've been in the trade for a while, and it's just bringing in a little bit of extra cash flow on the side. And then these other type of smaller trades are the ones that if you get a nice win out of it, you can pull in an extra $400, $500, $600 just using risk of $1 or $2. So $100 or $200. It's all about managing the risk, obviously, but you can do that more efficiently, I think, with these types of spreads. This is too much of a blow. On top of that, you're more than likely going to stop out of a trade like this, especially today. The market opens and you see it did not gap up. Now you're down roughly 50%, which is almost $900. That is a major blow. And one can argue you can go deeper out the money. That is true. This is the 685 strike. So that is this one all the way up here. Remember, if we're opening this position around here and we think the market is going to go up, you're now trading a deep out the money call. That deep out the money call is more affordable, but let's just say it's $10. So that's still $1,000 it's going to cost you to open, and by the time the market is pretty much closing, that trade is still down roughly 40%, which is down over $400. That is still a very tough pill to swallow, not to mention now the trade is still down and theta is going to be chewing away at this option, especially after the FOMC announcement today. Now, yes, we do know the opposing argument here that if the markets did go up or it gapped up, you would be up a lot of money and can actually close the trade out early in the day and there's no need to hold all day. That is very true. So let's just take a look at that scenario. Let's just say we did grab this call and the markets did gap up today to 865. How would that trade have been looking? So let's just say this is the market. Let's just say right now the market was up around here, we would only be up $82, which is not a lot of money. Now, if we were really right and the market did go up here, we're only up $180. As we can see, that is not a lot of money. Now, if we were to exclude all of these and we took a look, if the market went to 865, you guys can see this position would only be up about $100 or so because theta is eating away at this option. Now, if it did it earlier in the day, this position would have been up probably $300 or so. That would have been great. But for the most part, you guys can already see how difficult this is here. You need to be right, and you need to be right quickly. Or let's just say you're a beginner trader with a small account. It's difficult to be right in the time frame you're looking for. This just gives you a little bit more wiggle room. Now, let's just say the market did go all the way up to 885. This position would be up over $1,000. Yes, that's great, but look at the drawdown right now. It's down $800. These types of swings in your P&L can be damaging if you're trying to establish consistency or you're looking to build a system for yourself that allows you the time in the markets to improve. Looking at this looks excellent, but remember, you're asking for a lot for the market. You need to be really right. You're almost asking for the markets to be up over 0.5%, almost a full percent overnight on an FOMC when the market is already pretty choppy and there was already the establishment or the awareness that there is a lot of supply here. The likelihood was that the market would struggle around this level. With this scenario here, without broken wing butterfly, if the market does struggle around here, at least you're still in the trade and you're looking at a positive P&L as you continue to see what's going to happen later in the day. This is now 15 minutes after the FOMC announcement. If the market is still around here, you can still be profitable. And then maybe towards the end of the day, the market does make its little bit of a push here and you actually end up with a really nice win. In comparison, if we could exclude, again, all these other options and we're just long this call here, even if the market goes all the way up to here, let's see if we wait a little bit longer, you guys can see that it's still going to struggle to have some sort of profit, and the slightest move down can blow your account, and this is a dangerous situation to be in. So to refresh this page here, as I'm recording this video, the market is bouncing around, and now I'm only down about 6% or so, which is less than $20. As we can see, the market is recovering. If I was just in that call, I would have stopped out at least 5 times already for the day, and I would have been extremely annoyed. But I'm understanding that the market is supposed to be choppy around here. We are waiting for an FOMC announcement. Anything can happen, and that's the position I want to be in. At the same time, I'm comfortable with the risk for this position. If we break above 685, that's when I might add a call. I might just buy, a 1 DTE call for tomorrow on the SPY or the XSP, use a smaller position size and ride that momentum to bring in extra P&L. But this is the level we have to clear first. Instead of waiting to see, as I might miss that trade, let me actually set an alert on my chart here as I'm saying that, because after I finish with this video, I'm going to get it ready, prep it, and then upload it to YouTube. And sometimes I might miss a trade there. But for the most part, this is what momentum traders are going to be waiting for. I don't want to wait for that to happen. I'm entering prematurely, but I am entering the trade at an area of support. And if you're looking to be long, you want to enter at areas of support. The same thing, if the market made it down to 680, I would be then looking at maybe targeting 684. If we see some sort of wicks and hammer candles forming like this, if we start seeing supports and demand building up around here, I would look to target this level. I'm not necessarily a momentum-based trader, which means I'm not going to wait for the momentum to kick in to get long. I'm looking to position myself before the momentum kicks in. And that's easier to do, in my opinion, with spreads, because time can be on the side of the person that opens the spread. We just broke out of this trend here, so this might trigger some sort of momentum for today. If the market retraces back down to this trend and we see some sort of buyers coming in here, that might also give some confidence to people that are looking to be long for today, and we might just get up to here. Who knows? That's the point when you're trading. This video, again, is about risk management, and I just wanted to showcase to you guys, if you've been struggling this year, we're going into another year, it might be time to consider changing your approach to trading. If you've been struggling, all you do is just trade directionally by buying calls or buying puts. Trading broken wing butterflies is something I think can be very beneficial. You start small, start light. They don't even have to be this expensive. You can make these things extremely cheap. Let's just say we wanted to enter one for for tomorrow, another 1 DTE, and maybe you're targeting 6,900. You can make the butterfly extremely narrow. In this case here, the distance between your wings is very tight, as we can see. This is just 10-point separation between these two. This is 5 points. That's what makes it broken wing. And this is $1.50. Now, this is a deep out the money one, but let's just say you are thinking the market is going to be up 0.5% to 1% tomorrow. You guys can see here, there's a lot of nice room for some risk to reward. Or if we were to pull this a little closer, you can come a little bit closer to the money, and you can do something like this here, which is going to be a little bit more expensive, but the odds are going to be increased in your favor of if the market goes up 0.5% or so. You can also trade the XSP, which is even better for a smaller account. And if we were to do something like this, now you can have a much wider range and you can still keep the cost down. You can go really, really cheap with these things. So this is less than 50 cents. You can get it if you want. You can trade them around 30 something cents, 40 cents, and there's still room for the asymmetrical returns. And by asymmetrical, we're just talking about if the market was to be down a little bit, okay, so it's down 20 bucks relative to if it's up 40 bucks. So it's still some sort of a 2-to-1 risk to reward ratio. And then obviously closer and closer to expiration, there's room to make a lot of profit. Okay, guys, I hope you enjoyed this semi-random video. Just wanted to also showcase you guys a position I currently have running, as well as a position that is not currently working out, but how I'm able to remain in the trade. And who knows what's going to happen later today. Cross fingers for me. Position just went green. Maybe the market does explode after the FOMC announcements, and then around power hour, I walk away with maybe 500, 600, $700. I don't think I'll be holding this until expiration, but that would be beautiful to have such a small position that at the lowest point, I think it was down $130. At yesterday's close, it must have been down around $60 or so. The P&L or the graph for this position was not really that bad, as you guys can see here. This was yesterday. It was around $3 and I opened it for $3.70. So I was down just under $70 yesterday. It's closed, which is why I wasn't that nervous as I went to bed. All right, guys, I'm going to end it here. I'm still a little bit rambling. Like the video if you learned something. Subscribe, leave a comment. Thanks for watching.